Hi guys, Mark Chapman here. I'm the creator of the trademark Trap Traders concept. You might have noticed I've got an umbrella. The weather's terrible here in the UK, but the reason why I'm out in this bad weather is because I've been purchasing some goods at the Windlebridge Garden Centre. Strongly encourage you to visit that place, it's very good. And I've been purchasing this bad boy, the mighty tulip. Now this thing, as the email suggested, back in the 17th century would have cost you 10 times your annual salary, and people were trading in land and property to own just one of these things. Now why would people be doing that? Well, humans tend to get caught in bubbles all the time, and it would have seemed like a good idea because many people would have been making money as the price of the tulip was going up. One of the most recent examples of this would be the property market back in 2008. Everyone believed that you couldn't lose money buying property. Every 7 years it doubles, right? I'm sure you've heard that before. These types of situations happen all the time in the currency markets. The market's making a series of higher highs and higher lows. All the books and gurus tell you that you should enter, and no sooner do you commit that capital, believing because there was some confirming price action, that's what's going to happen, prices will follow through. You enter, take some risk, and down comes the price action, trapping you in those trades. I've developed some concepts that will ensure that this never happens to you again. This information is free, and I encourage you to watch this video all the way to the end, and I'll see you on the other side. This particular type of trading trap is known as a structure failure trap. I'm also going to explain to you what value looks like on a chart and how you can understand the difference between value and price, which can add weight to any trading decision you may take. This is a daily chart of the Australian dollar. However, it doesn't really matter because this is in hindsight. What's important is the structures and the analysis. One of the most critical elements to be able to trade traps successfully is to understand the context of price action pre-trap. What I mean by that is, at the hard right edge of the chart, what had price been doing prior to the trap setting? It's not very useful to trade traps in the center of a range because there won't be that many people who care or notice those price structures. What we really need to see is price moving in a dramatic fashion. The more vertical, the more fast moving, the bigger the candles, the better the trap, because this is the perfect price action that draws the trader in to take in some risk. And then once they're in the game, their money becomes a target. So if you're going to outsmart your opponent, you better start thinking like them. And as you can see, price dropped extremely strongly in this area here. And that's precisely the type of price action that you want to see when considering a good trading trap, because at the hard right edge, that would have seemed as if it was selling off strongly. A big momentum play like that would catch the eyeballs of many reactive traders. That's the type of price action that gets people excited, and that's precisely what we need for them to take some risk. From there, you can see that price retraced up to the 23.6% Fibonacci level. When you see a big drop like that, you would expect then retracement traders to be very excited and primed to enter some shorts. But as you can see, that candle reverses on itself, and then the next candle, that negative bear candle, sells off again, and then you get that strong bullish candle away. This would be a very nervous situation for those traders who are trying to get on board at the lower end of that move. They're probably starting to panic as they're now offside in those trades, and if they get the chance, they'll start bailing out, because a break-even trade is the next best trade once you realise that you're losing money. So as price takes another dive to the lows, you would expect to see some demand in here as those late Fibonacci sellers start to bail out of their trades at break even. And the transaction that occurs when that happens, if you're a seller, you must buy to exit. The other element of this trade that I really like is the presence of this value area here above the entry. Price doesn't always represent value. There is a difference, and sometimes price becomes cheap relative to the value of a currency, and also it can become expensive relative to the value of the currency. And price has a tendency to trade back into value on a regular basis. The best way to describe value, if you think about your own home value and the value of the properties around your home, if all the houses are 4 or 5 bedrooms and very similar in size, then there'll be an overall average value to those properties. Imagine if the average value was $300,000, but there was a guy down the road that wished to sell his property that was very similar to all the rest for for 500,000. He may wish to get more for his property, but the fact is he'll struggle to sell that property at those prices. And the reason is price is too high relative to the value. And no matter how determined he might be to sell it for that higher price, he's unlikely to do so. So if he wants to sell it, he's going to have to drop the prices. Likewise, perhaps he's in a rush to sell and he needs to get out of his property and just liquidate that cash. So he offers it for sale for 200,000, 100,000 below the accepted value for a property of that size. It would be my guess that he would get quite a few inquiries. And the reason is because it's cheap. The price is below the market's understanding of its value. And because of this, people will be willing to make that transaction. If you think of this area on a chart as a value area, it's never precise. So when you sell an item, let's stay with the house analogy, and 10 people come and make you an offer, not all 10 will come in at 300,000. One may come in at 310, one might come in at 295, etc, etc. But there's a mean to it. So if you think of this as 310, 315, 305, 295, 270, 307, etc. You get the idea, but that's the mean and it averages out to 300,000. When price drops like this, this will be considered a cheap deal, a bargain if you will, making this very attractive to buy it low and get the difference between the price and its value. This is a great tip and you should always look out for areas on a chart where this occurs. Don't rely on any indicators, let the market tell you what its value is. When used in conjunction with traps, it's a thing of beauty. Hello and welcome back, and I hope you found that information extremely valuable and you'll no longer get faked out when a trend is occurring. I've discovered over 20 different types of trading traps that not only stop you getting faked out on a trend, but also in breakouts and in many different other circumstances. I know you're tired of the same old promises that never seem to work, but I hope you've realised that my information is different. And I'd like to hold your hand every step of the way to teach you my trading traps in my live trade room. So click the button below and join me for my live trade room and I'll see you on the inside.